Okay, let us start. Starting from this seminar, we are going to proceed to finance topics. For finance topics, I don't have an exercise workbook because I'm literally creating these exercises as we go. This is the first time I'm delivering this module. That's why there are no printed copies just yet. I will prepare them week by week. What we'll do now, in the first part of this seminar, we will focus on the review questions, which will help you to just recall what you were supposed to study last week. As far as I understand, as far as I can guess, many students didn't really learn majority of the material last week because you were preparing for the test. Am I right? Yes. So basically, you are not well prepared for this seminar and you won't be able to answer multiple choice questions straight away. That is why in the first half of the seminar, we'll go through the review questions, which will cover majority of the material which I've delivered last week. So what I want you to do, I want you to look at your lecture notes. So you download lecture slides. You can use your smartphone or laptop or whatever you have, right? If you don't have a smartphone, you can share it with some of your classmates. Refer to lecture notes. You can work in pairs if you prefer, and prepare answers to these questions. I will show them on the screen. Please prepare these answers. I think we'll probably spend maybe half an hour on this for you revising this material. I will go through the solutions, through the explanations. This will help you to remember the material, so you will learn some of this material for the first time. And in the second part of the seminar, you will focus on the actual multiple choice questions, which will be similar to what you will get on this topic in the actual assessment. Does it make sense? Yeah? Okay, let's start with these review questions, please. The first question, which of the following should be the main goal of the board of directors? The main goal should be maximization of shareholders' wealth. I'll show you the answer with a few more details. The thing is, economic objectives and financial objectives of the company are not really the same thing. In the economics part of the module, we used to believe that it is profit maximization which each business pursues, which strictly speaking is correct, because if the company is not profitable, it will not be able to survive over the longer term. However, in practice, businesses exist for their owners. People create businesses to earn money, to make money. If the business doesn't make money, the owner will move capital elsewhere. They will relocate their capital, because that's why the businesses have been created in the first place. Moreover, the thing is, in practice, the thing with profit maximization is that this figure is in fact rather subjective. We know that profit is the difference between revenue and costs. Again, in theory. In practice, it doesn't quite work this way. Have you started studying any accountancy modules, by the way? Are you doing any accountancy just yet? Not yet. Okay, when you will start studying accountancy, you will learn that revenue and costs are recognized in the period in which they occur. It means that you have produced, let's say, desks, right? You have spent a certain amount of money to produce them, you have incurred certain expenditure, and you have managed to get certain revenue. You've sold them, you've made a contract to sell. This does not necessarily mean that you've been paid for these desks. It also does not necessarily mean that you have actually paid for the costs of making these desks. The revenue and cost, and therefore profit, has been recognized in financial statements, but it doesn't really mean that you have received the actual profit in your bank account. It doesn't mean that the money has left your account to cover your expenditure. It doesn't mean that your customer has actually paid you. Because in real life, in many cases, items are supplied on credit. You get something first, you pay later, and your customers will do the same. So there might be, in real life, there might be a gap, the discrepancy between the actual profit made by the company on paper and what the company has in real life. And sometimes the delays, the differences can be substantial, especially in companies which operate on subscription terms. For example, nowadays, there are quite a lot of new companies, software companies, which work on subscription as a service. This is how they are called. Subscription as a service, which means that they get customers for, say, a year or 3 or 5 years, right? They sign a contract, which means that the customer is obliged to pay for the whole 5 years. The sale was made to cover supply for the next 5 years, but the money will actually arrive to the company's account every month on a monthly basis. on a subscription basis. You commit to buy a certain product for 5 years, so the profit has actually been made by the company, but the money was not received. And there are quite a lot of companies which operate in this particular way nowadays, especially in software sector. And they will have huge discrepancies between the actual profit and cash flow in the company. So profit can be subjective, and profit figures can be manipulated depending on how you recognize your profit, for which period, how do you treat the terms of your deals with the customers, terms of the credits and so on. Moreover, profit has no time dimension. When I tell you that the company should maximize the profit, we don't know what period we're talking about. Are we talking about the long-term or short-term period? Do we need to maximize the profit which we receive during the next year, or let's say during the next 5 years or 10 years? It's not really clear, and economic theory does not really focus on this, but it is important in real life, in real practice, in real businesses. Moreover, profit does not take risk into account. In other words, you can be maximizing profit, and in order to do so, you can be pursuing very risky projects. You can invest in very risky projects which can put you at risk of suffering significant losses. You can get a huge profit, but on another hand, you can get huge losses as well. Is it really better to pursue the high profit in this particular way? Not necessarily. Not every shareholder will want to be subject to this significant risk. So profit is not ideal figure, is not ideal number to maximize in real life because of some of these difficulties. Sales maximization also has an issue. We know, we've learned from economics, from one of the topics, that the company can choose to maximize sales. The company can try to capture the highest possible market share, especially in the beginning of its operations, when it just enters a particular market, when it needs to capture the maximum loyal customer base, and then hopefully start to get some revenue and profit later. This can happen, but in many cases, when the company enters the market first, it will try to undercut competitors in terms of prices. It will make lots of sales at a loss just to attract customers. It will spend a lot of money on promoting their products. So you can be maximizing sales, but not at good prices. Your prices can be suboptimal. You can make lots of sales at very cheap prices, and as a result, you will be suffering from losses. So if you take this to the extreme, you can overtrade, you can stretch yourself too far. Again, overtraded is an important concept in business studies. If you've done business studies at A levels, you will be familiar with this concept. Overtrading is a situation when you actually try to bite more than you can chew. You attract too many customers and you cannot really serve them well. You cannot cope with the amount of demand, which can lead to significant problems. Right? Maximization of benefit to employees and the local community. It's good to work as a charity if you are a charity, but businesses exist to make money. And if you try to please everyone, apart from the owners of the company, the business will not survive for long. You do need to take their opinions and their interests in the account. You do need to take other stakeholders' interest in the account when you make business decisions, because if your workforce is not satisfied with the working conditions and pay, you will lose your human capital. So you need to have good relationships with both customers and your employees and your local community so that they support your business. But they need to be satisfied. Their interests need to be satisfied rather than maximized. You still need to remember that the business exists to make profit for the owners of the business. So this is not the main goal. And in reality, in real life, the main financial objective for the organization would be maximization of shareholders' wealth. Shareholders are the owners of the corporation, of the company. They want the benefit for themselves first, and this should be the prime objective, financial objective for the organization, and therefore for the financial manager who is employed to pursue this specific objective. In actual slides, there was a slide which explains the differences between profit maximization and shareholders' wealth maximization. So it gives you a summary of what are the main differences. In economics, of course, the whole economics is based on the assumption that we maximize profit. In real life, the finance works slightly differently. These goals do not contradict each other because you cannot really maximize shareholders' wealth unless the company is profitable. However, it just looks at the company's operations from a slightly different angle. It's more long-term oriented. It's concerned with maximizing market capitalization of the company and its share price rather than profit on paper. Also, it takes risk into account and it takes timing of cash flows into account. And a timing of cash flows is what we are focusing on in lectures this specific week. Any questions based on this material? No? Okay, let's move on. Next question, why profit maximization is considered incomplete compared to what businesses actually try to achieve? For these specific reasons, because it lacks a time scale, we don't know whether we talk about short-term or long-term, during which period do we need to maximize profit, or because it doesn't take risk into account, etc. And here, in this example, we focus on the short-term profit maximization, which the business might pursue at the expense of the long-term profitability. You might be maximizing profit temporarily by doing something, by cutting the cost dramatically, by reducing customer service, but the business can lose out in the longer term. And profit maximization does not address these issues. Again, a similar question, again from a slightly different angle. Why maximization of wealth is superior? For these reasons, because the term of profit can be ambiguous, because different measures of profit can lead to different results and decisions, because it's a short-term rather than long-term objective, because it ignores risks, right? And generally, shareholders' wealth is superior because it addresses all of these issues, and it takes all of these factors into account. Any questions? No? Why maximization of share price is preferred to sales maximization? Again, there was a slide in the lecture. Let me just find this slide for you. This slide tells you that there are some equivalent financial goals. This is what we are trying to achieve. We try to maximize shareholders' wealth in reality, right? And in order to do so, we can actually maximize share price of the company, because share price in modern efficient markets will reflect all information which is available to investors, to markets, about the functioning of the company. Any future prospects of the company and any changes in future prospects and future profitability will be immediately reflected in the share price. If there are something good happening about the company, for example, the company launches a new product successfully, or in a new recent quarterly report, it demonstrates that its sales are increasing dramatically, it has attracted a lot of customers, it is growing quicker than competitors, it will immediately be reflected in the share price. Share price will jump straight away. It's not uncommon for share prices to jump by 10, 20, 40% in a matter of days as soon as the quarterly report is released, right? If you are an investor, if you ever invested in the stock market, you would be familiar with monitoring these quarterly reports of the companies. It is well known when they will be released, and every investor monitors quarterly reports just to check how it will affect the stock prices of companies in their portfolio. I do this too personally. So share price will reflect all available information, and if you focus on maximizing share price, you will maximize shareholders' wealth. Because what is shareholders' wealth? Shareholders' wealth can be maximized by maximizing dividends paid to shareholders and capital which they can earn by reselling the shares. You buy shares in the hope that you will be able to sell them later, right? So you hope for capital appreciation, and while you hold them, you also receive dividends. By maximizing these two items, dividends and resale price, you are maximizing shareholders' wealth. So share price is important because it determines how much you will be able to get when you resell your shares later, at a later date, after a holding period. So share price can be a substitute for shareholders' wealth. You can focus on this. How can you maximize share price? Share price depends on the total value of the company, which is the market cap, market capitalization. So market cap is simply the total combined value of the company, right? And it is also equal. It can be calculated as number of shares in circulation times the price of each individual share. This is what market cap is. It's simply a combined value of all shares in circulation, of all shares which were issued. When you're maximizing the share price, you are maximizing the market cap of the company, which is a combined wealth of all shareholders, right? And how can you maximize the market cap? How can you maximize the value of the company? Company or any asset is actually valued depending on cash flows which it can generate. This is what we started studying this week. Market cap, its net present value, is maximized by maximizing cash flows which it generates. And these cash flows are discounted. We can see that different cash flows will occur at different time. And in order to account for this timing of cash flows, we calculate their net present value, their net value in present terms. This takes into account any costs associated with these cash flows, and these are net cash flows. So strictly speaking, by maximizing some of these, value of cash flows, corporate net present value, market cap, or share price, we are maximizing shareholders' wealth. These are alternative financial objectives. These are equivalent financial goals for the financial manager. And share price is a very simple thing to maximize because it's very obvious. It's known to everyone. This information is readily available. It's independent. It's an independent yardstick which is generated by financial markets, by numerous participants, financial participants. So it cannot be manipulated. It cannot be as readily manipulated as profit figures. That is why it is considered to be more preferable compared to any other financial objective. Have a look. This was the question. While share price maximization is preferred to sales maximization. Again, sales measured in revenue rather than in cash terms, and revenue recognized in financial statements, revenue on paper, does not necessarily mean that you have received cash, because you can sell your items on credit terms. So it doesn't necessarily represent cash inflow for the company, because they can be offered on extended credit terms, and these extended terms also pose the risk that you will never be paid. Right? Because if a customer requires half a year to pay for the supplies, maybe they have issues with payments and maybe they won't be able to pay you eventually. And these sales will turn into bad debts instead. You won't get any payments at all, right? Sales can be maximized on mispriced goods, which means that you maximize your sales by offering too low prices, and as a result, you will not maximize shareholders' wealth. That is why maximizing share price is preferable. Okay, any questions? How can it be done in practice? As we've just explained, in practice, you can try to maximize the present value of cash flows which are obtained by shareholders. So the present value of dividends and capital appreciation and share resale price when you sell the shares after a holding period. And because share price reflect all of these in efficient markets, you can try to maximize this. Later, in the remaining few lectures in this module, we will also learn a few criteria for investment, for the choice of investment projects, investment appraisal. How do you select between alternative investment, which can generate different cash flows at different time, which can pose different risk and require different amount of invested capital. And we will learn that you need to choose projects with positive net present value. We'll learn how to calculate net present value of a project and how to use net present value to compare alternative projects. So strictly speaking, in reality, you maximize all of this. You achieve your objective by choosing investment with the maximum net present value out of what is available to you. It must be positive, and you should select out of options available the project with the maximum value. Okay. We've covered all of this. Again, this is all repetition of what we said. Agency problem, the new concept, which is also covered in the previous week. Quite a few questions in the question bank based on the agency problem. So you need to be aware what this is. The agency problem, or the principal agent problem. In finance, the term usually is used, the agency problem. In economics, we say principal agent problem. This is the problem which occurs due to the separation of ownership from control in a modern organization. Let me switch to slides. This is the slide. In a modern corporation, the company belongs to shareholders. These are the actual owners of the company. But in reality, it is governed and run by the management. It is management, CEO and financial officers and other executives. These are these people who make decisions, who decide on the functioning of organizations. Shareholders, strictly speaking, or majority of them, do not control the everyday functions and decisions of the organization. This is what is called separation or divorce of ownership from control. Organization is owned by shareholders. These are the owners of the company. They are also called principal. Principal is the owner of the company, right? But it is controlled by the management. And managers act as agents for the owners. So that is why it is called a principal agent problem. The conflict of interest between principal, the owner of the company, and managers who are the agent for the owner. Principal agent problem. Why there is a conflict? Because they have different objectives. Managers can in fact pursue their own objectives rather than objective of shareholders. For example, a CEO can try to maximize their own job security or their own salary package or their own bonuses. They pursue their own individual objectives. They want to be rich. They want to become rich themselves rather than to make shareholders rich. And this is rational because everyone is concerned about their own welfare. And this is what happens in reality. Managers can pursue their own objectives, what is convenient for them. They can try to minimize the amount of work for them. They can try to maximize their own payouts rather than benefits for the shareholders, right? Why does this happen? Because shareholders do not necessarily have a way of monitoring managers' decisions on everyday basis. They cannot necessarily control or affect these decisions, especially if you are a minority shareholder, right? And as a result, managers can pursue their own objectives. This can lead to principal agent problem when principal's objective, wealth maximization of shareholders, is not actually achieved. This is what is happening. How can it manifest itself? What can happen in reality? It manifests itself in the decisions which managers can make. They can choose investment projects which they prefer rather than the ones which will be beneficial for the organization, for the business, for the owners. They can be bribed. They can choose the projects which they simply like, or they can pursue the projects which will be beneficial for their family. For example, they can sign contracts with their wife's corporation. This is not necessarily the company which will be the best partner, but their family will benefit as a result of this. Agency problem can also manifest itself in the financing decisions made. What is the financing decision? Financing decision is concerned with how you find the money for your investment, how you finance your projects, where do you get the money from. And you can actually use a different mix, a combination of, for example, new stock issue and debt. And sometimes managers can prefer to issue new stocks rather than to attract debt. Why is that? Because it can be cheaper. Debt incurs certain expenditure, which raises costs, which lowers financial profit on paper. But on the other hand, issuing new stock dilutes existing shareholders. You issue more stocks, the number of shares in circulation increases, which means that the share price of each individual share declines. So existing shareholders will lose out as a result of this. And this is what frequently happens. As soon as the company announces a new share issue, very frequently share prices drop, and sometimes significantly. So existing shareholders will lose out. However, for the manager, it will look really great because they haven't attracted their debt. Their debt to own capital ratio has improved. They have not incurred additional expenditure on servicing this debt, right? So this decision can sometimes be suboptimal for the shareholder. For shareholders. And there might be some other ways in which the agency problem can demonstrate or can present itself. There was a slide based on this in the lecture notes. Please look through this. And I've also provided a little paper, a little article on agency problem in Lehman Brothers. Are you aware what Lehman Brothers are? What is this company? What is it famous for? Lehman Brothers? Absolutely correct. This is the bank which crashed the world in 2007. So the whole global financial crisis started with the collapse of Lehman Brothers. This was one of the biggest financial organizations in the world back then, 14 years ago, and it went bankrupt. It was a complete shock for everyone because no one could believe that this company, which is like 100 years old or something like that, could collapse, and it did. And as a result, it caused a domino effect when quite significant proportion of financial system in America collapsed as well. This caused the global financial crisis, credit crunch, and the global recession in 2007. And I put a little article on the agency problem in Lehman Brothers on Moodle. If you want, you can read through this just to get an idea of some other examples of how the agency problem can manifest itself in a company. What can happen? due to this separation of ownership from control. To give you a few more examples. How can it be addressed? Again, there are different methods, and there was a slide in the lecture. You can do nothing because it can be costly. The cost of taking action can be quite significant because you cannot monitor the manager or the CEO on everyday basis. It would be very costly for you to try to do so. So sometimes you deliberately choose to do nothing, which means that you agree that the manager will do okay-ish. They will not maximize their performance, right? But you will be satisfied. They will try to please you. They will not work too hard for you, but you will be okay. So you are likely to get kind of normal profit by investing in this particular company. This can be a rational choice in some situations. So if the cost of these suboptimal managers' behavior are low, so they're kind of doing okay, they take your interests into account, they're not trying too hard, but they're doing okay, and the cost of monitoring are too high, you can prefer to do nothing. Sometimes you can try to increase monitoring if what they're doing is very costly and they need to be monitored, otherwise they can misbehave. And most importantly, you can use a reward punishment contract. In other words, you can try to set their salary, their remuneration package, set up it in such a way that you create incentives to behave well. You create rewards for good behavior. For example, if share price increases by, let's say, 20% per year, they will get a bonus or something like this. You create a system of bonuses or provide them with share options to make them shareholders as well, which means that their interests will coincide with yours. If they're also shareholders, they hold a certain package of shares of the company, they can get shares as a bonus for good performance. They will be interested in maximizing their own wealth, their own portfolio of stocks, and they will do what is good for the company overall and for you as well as the original shareholder. So there are some different ways of doing this, and there are more ways which I've covered in the lecture. Please refer to this. Common ways in which the company can encourage managers to act in a way which is consistent with your objectives. This is what I said. You can use the system of punishment and reward. You can also regulate the functioning of the organization using government regulation by auditing financial statements to ensure that they're accurate, fair, correct, and they're truly reflecting the financial performance of the organization, to ensure that they don't cheat, they don't make up their financial statements. Legal system, reputation system can also affect their behavior, and hopefully they don't want to lose their reputation if it will become known that they're cheating their shareholders, and so on. So have a look through this. Clauses into managerial contract to reduce agency problem and encourage goal congruence, incentives, punishments, official constraints, etc. So there are different measures. Quite a lot of this is available in your textbook. So it's a new textbook which we are using for finance part of the module. It's available as an ebook as well, so there is a link on Moodle. And for this first lecture, you need to read the first chapter. There are quite significant discussion. Please prepare yourself. This is an easy topic. Just be familiar with this so that you are not surprised by questions in a question bank. Okay, you can take a quick break, and after the break, we'll focus on the multiple choice questions, which will be very similar to what you will get in the actual assessment.